Billionaire investor Bill Ackman just announced that he's acquired a multi-billion-dollar stake in Uber stock, causing the shares to jump higher. That's UBER. He thinks there's a massive discount in Uber. And why does he think that the stock has a lot of upside from here? I'm going to walk you through that in this video. I'm going to go through their most recent earnings, as well as a big development that I think incrementally makes the thesis a lot more constructive, and why I think I personally am turning on this. Where previously I was a lot more cautious because some of the developments with Waymo, we'll talk about that towards the second half of this video. I think there's been a big technological announcement that does favor a platform like Uber. So let's get into it. I'm personally getting a lot more excited about Uber as I see this change. And so that's the second half of this video. But first, let's talk about what Bill Ackman sees. What is he exactly saying? As always, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, please make a point of hitting that thumbs up, hit that subscribe button. This is a no hype, mission focused channel trying to find you potential multi-baggers, the types of stocks that can go up hundreds or even thousands of percent over time. So at the very end of this video, I'll walk you through my own sort of framework, my hypothetical framework for how I think it could play out over the next 5 years. So Bill Ackman's thesis, calling out, look, he owns 30 million shares, ballpark at around $75 a share. That's a little over $2 billion investment. It looks like around a 1% stake in Uber. He's been a day one investor in Uber after the actor Ed Norton showed him the app in the early days. He talked about how it suffered from erratic mismanagement. And then you have the new CEO, since 2017, who's done a fantastic job, talking about how it's one of the best managed and highest quality businesses in the world. And he thinks that it still trades at a massive discount to its intrinsic value. We're going to talk about that valuation. But first, I think before you understand the valuation discount, you need to look at their most recent earnings, which just came out earlier this week. This is a fourth quarter, and management saying, look, this is what we targeted. We targeted mid to high teens, growth in terms of gross bookings. We're talking about growth in adjusted EBITDA of 30 to 40%, talking about free cash flow conversion of 90% plus. And in 2024, they delivered it. 21% growth in gross bookings, 60% growth in adjusted EBITDA, 106% conversion into free cash flow. This is what investors like to see. Management saying we're going to do this and actually doing better. Zooming in a little bit on the details, this is one of the KPIs or key performance indicators for Uber. You see that the average users up, the frequency of their trips also up. So broadly, you're seeing more trips. This means the business is healthy. This is what you want to see. Gross bookings in the fourth quarter up around 20%, depending on if you're looking at, currency adjusted up 21% after you factor in, the US dollar fluctuations. Now it's closer to 18%. And digging in a little bit, because there are multiple segments here. Their mobility, getting from point A to point B, you had around $23 billion in bookings, of which roughly 30 cents of every dollar of gross bookings actually goes to them as revenue. The rest goes to the drivers, of which you can see that they're, incrementally better margins over time. It's not a steady, up and to the right. There still is a lot of progress here, but that it is improving, and it is suggesting that there's a lot of profitability here currently. So that it's getting better is what I like to see. From a delivery perspective, getting, goods, grocery, food, lots of different things. Over time, these are going to be huge, big segments. This is not just, hey, I need to take a cab. They're looking to tap into getting stuff, moving stuff around, whether or not that means you have, prescription and you don't want to go to the local drugstore, you want it brought to you. It's going to be everything. It's going to touch so many different things. The platform potential is just huge for it. We'll talk about that more in the second half of this video. Plus, you have subscriptions that are growing very well. So delivery also doing well. You can see around 18% growth in gross bookings. So that's a little bit slower than what you saw with their mobility segment, going from point A to point B of 24% growth. I think this is important. When you understand mobility, there's going to be a little bit more, there should be an expectation of volatility with some of these, numbers, because if you ever have any sort of recession where, all of a sudden consumers feel the pinch, maybe they go, I'm going to take public transportation or take the bike. And you do have that sort of element where, investors need to be mindful with the Uber thesis. Maybe they're a little less likely to get a food delivery. With the economics of delivery, $20 billion in bookings, of which, less than 20 cents per that dollar they're recognizing as revenue. So the rest of it, because, delivery is such a tricky business, in terms of who's getting, parts of the pie there. So this is a much, much smaller margin business. You could see previously on the mobility that was closer to 7-8%. Delivery, this is incrementally getting better each quarter, marching higher. Still a long ways to go before this is a very richly profitable business. I mean, it is profitable, don't get me wrong, but I think margins could be much higher long term, and I think that's what Bill Ackman is playing for. Freight is sort of ho-hum, not really going crazy. You see zero growth and still unprofitable. We'll see what ends up happening with this segment over time. Maybe it gets sold, who knows. So on a consolidated basis, EBITDA is, growing at a very good rate, which suggests not only are they managing their gross bookings and their top line, their sales in a great way, but they're managing their expenses very well as well. So this suggests that management is taking the business seriously, thinking about how do we get to better profitability over time. And I think what Bill Ackman loves to see is the free cash flow. This is a cash cow, generating around $7 billion in free cash flow in the most recent year. Yes, a lot of it's stock-based compensation, but if you zoom out and think, okay, what is it going to be? What is their free cash flow going to grow at on a per diluted share basis going forward? That, I think, is the framework. That's how you add back the stock-based compensation without being, overly draconian in your valuation. So $7 billion free cash flow on $160 billion market cap, and that's roughly at $75 a share. So that means you're talking around, low 20s type of price to free cash flow multiple. That is not expensive if you think that this enterprise and this platform still has an opportunity to keep growing at, let's say, 10% plus a year. I mean, think about it for a second. Step back. And 10% plus a year on a per share diluted basis. Think about it. You have a global market of investors buying treasury bonds at 4 to 5% yields. So if you can get a 5% plus yield equivalent shareholder year, this free cash flow is accruing to you. You may not get it directly, but it's accruing to you on the balance sheet of this business. If you have a business like Uber, 5% plus yield, and it's growing 10%, what's that worth? Especially in a world where treasuries are 4 or 5%. So I think investors might say, hey, this valuation is really quite reasonable because you have this growth, whereas when you buy a treasury, there's no growth. There's no 10% plus growth that you're expecting over time. So I think that's part of the reason why Bill Ackman's saying, look, this is a low multiple to free cash flow given the growth prospects that he sees ahead. And so, what's the big change? Because we've talked about their results and there's a lot of great stuff, a lot of great execution, but I think there was a big fundamental change just in the last few days that really made it obvious to me that the thesis for Uber is getting better. First of all, as always, this is not financial advice. Also, just yesterday, Rakesh, a premium member of the Unrivaled Investing community, shared, this was literally yesterday in our Discord. He wrote, "Congrats, Daniel. Thank you very much." He's talking about this channel crossing 100,000. So big thank you to you, who the subscribers that are tuning in. Maybe I'll make a video on crossing 100,000. If you have any questions, I'll consider addressing that. And so Rakesh says, "You deserve much more for the value you provide and hope this continues. Investing is becoming like casino gambling in recent years with all quick money and few lucky trades, but your no hype mission focused mindset is what convinced me to follow you over others. Please keep this secret sauce as is." If you'd like to learn a little bit about the secret sauce at Unrivaled Investing, come check it out. I share, my insights on a weekly basis. I have a monthly video that's exclusive for subscribers over what I'm finding interesting right now, the stocks that I'm considering adding to. So come check that out. That's unrivaledinvesting.com. So I previously did a video on Uber potentially being disrupted, and I was sort of mixed on it. This was when the stock was a little bit lower than where it currently trades, but I think it's important to, just because it was lower previously and now it's a little higher, you need to look at the reality and what's changed. They posted very solid earnings. They continue to execute with margins. And there was a big technological development that I think caused a lot of people to wake up. So this is the chart that got investors nervous. There were a few charts like this actually showing that in new markets where Waymo, that's Google's autonomous vehicle, where they launch, they're potentially taking market share from Uber because Uber is the dominant player in ride sharing. You also have Lyft, but you have folks increasingly going to Waymo. And part of the theory is that it's just like, wow, this is really cool. I have yet to personally go on a Waymo. I've seen them, but I'd absolutely love to it. And the theory is maybe people are just signing up directly, going direct to the Waymo because of the novelty of it, and that long term people will fundamentally care about price and convenience. Will I get my car in a convenient way? Of which, if you don't have the best network with the most, the best supply, maybe Waymo won't be there. Maybe it'll take you longer, but maybe there's a safety aspect for it where you prefer having, no one talking to you in the car, and you prefer the safety that's brought from a robot or from AI. But the fundamental change that really actually made me start thinking about Uber over the last few days was seeing the news about DeepSeek. And if you're not familiar, what DeepSeek, so this is a Chinese hedge fund that came out with a reasoning model that was near parity with one of the best solutions that OpenAI announced. This caused a lot of stocks to fall because DeepSeek was lying about how much chips they actually used and how much, it cost, and saying it only cost $6 million. They were providing signaling to really confuse US investors, in my opinion, and global investors, try to slow down the AI investment in the US industry. And the DeepSeek announcement with this R1 reasoning model, it woke, I think, a lot of people up to the reality that there's not going to be just one AI company, and that there's, and it's not just going to be Waymo and Tesla that succeed with autonomous. And because at the end of the day, autonomous is artificial intelligence. And if you can say there's going to be a lot of different smart AI models available, and that there are going to be players around the world looking to offer these models for, how fast they run, how safe they are for consumers. So that moment, seeing DeepSeek launch, made me realize, okay, in the next, decade, this isn't just a market for Tesla and Waymo. There's going to be a lot of players, in which case the platform aggregators, the one who owns the consumer and owns the supply, like an Uber, is going to be in a very strong position. Previously, my concern was if you had just, let's say, two new supply additions, Waymo and Tesla, because they were the, let's say, dominant autonomous vehicle solutions, then that could really, it could disrupt Uber's business model, because you'd say, oh, well, maybe I'll take a Waymo, or maybe I'll take a Tesla, and, that'll become my ride hailing solution. I think the realization from DeepSeek just in the last few weeks does make it very clear. A lot of companies, at least a dozen in my mind, are probably going to succeed. And Uber's sort of calling that as well out in this slide, saying, yeah, there's a lot of autonomous vehicle tech advances. There's a lot of players that we're considering partnering with, but we're going to be the partner of choice. And there's going to be all these players that, might come to us to say, hey, we have the autonomous technology, we'd like access to your consumers. And so arguably Uber is going to have to be the gatekeeper and say, hey, do you meet certain, safety thresholds? Do I trust you? And that is a really strong platform position, because you have the consumers on the one side that say, hey, this is convenient. This is the fastest way for me to get a safe car. And then, you've got the supply as well, because you're connected to all these different platforms. My concern was if it was just Waymo and just Tesla that had that autonomous solution, then, they could arguably push back on Uber, and you could start getting some compression in terms of your margins. Because if your supply base is only it gets concentrated into a few players, that makes it much harder for you to charge the margins that you want to see. And that's why Waymo's pushing for getting direct access to the consumer. That relationship's worth a lot. But if you have a diversified supply base with humans, hundreds of thousands, millions of humans still driving, and a dozen plus autonomous vehicle solutions, you're a lot less likely to face that margin pressure on the supply side of Uber's platform. Plus, they also call out, look, even if they wanted to compete, it's really tough to get this right, because the amount of traffic is so variable at given points of the day. So if you're going to have a fleet of cars like Waymo, are you building your fleet for the average amount of traffic, or are you building it for peak? Because if you're building it just for average, then you're going to have problems when it's peak, because people are going to say, it's taking me so long to get my Waymo. But if you build it for peak, you're going to have all these extra cars sitting around around during the non-peak hours. That's the advantage of Uber, is that it can alert folks. It can say, hey, we can tap into this supply and let folks know, oh, pricing has gotten a little bit more favorable, and that's the fundamental solution versus the fleet the fleet operators and owners, like a Waymo. Plus, so this fundamental change and a belief in more autonomous vehicle solutions over time, that has fundamentally changed and makes me more constructive on Uber. And I think management's very aware of this, saying, look, the current cost per mile for getting a some sort of Uber, whether or not it's an Uber XL or Comfort or XShare, it's well north of $2 per mile. But as you get to lower and lower levels, where maybe it costs $1 per mile, you create lots more opportunity in terms of what people want and in terms of value being delivered. You're creating potentially trillions of dollars in terms of opportunity that can then flow through their platform, because you have this sort of explosion where it's like, well, if my groceries are going to cost an extra $10, would I really want it? But then if it's like, well, the grocery store is only a mile away and now it's changed where it's only $1 extra to get my groceries custom delivered, then it's like you see that explosion and you're going to see a lot more people going, yeah, of course I'll pay for it. And you get that, that goes to Uber's advantage, is that yes, the dollar per mile goes down, but the volume of new customers or the frequency of those customers paying will just go much higher, creating a huge opportunity for Uber, creating this $1 trillion plus opportunity. So you could see the revenue go from roughly $40 billion to hundreds of billions of dollars in the future. Thinking about the quality of Uber, thinking about, the outlook, the financial health, looking at their balance sheet, their cash flows, their revenue, their track record. Broadly, I'm not seeing really any red flags at this point. The real red flag previously was the concern about Waymo and Tesla potentially crushing their supply or, crimping their supply margins. So I'm looking at this now and I'm thinking, yeah, there's maybe a couple of yellow flags. You'll still have some sort of bumps and hiccups, because you'll have, what will be maybe Waymo enters a new market and then, Uber will lose a little bit of market share because of the novelty aspect. But once again, it's going to come back down to, what do people want to wait around, or do they going to say what's best and, fast and cheapest? And in that case, the platform is going to win. So you might have a little bit of, turbulence as they enter new markets, but as you see more and more autonomous vehicles enter, I think Uber is more and more likely to be a winner. At least that's what I'm seeing so far based on consumer behavior. At around $75 a share, it's a $161 billion market cap, versus 40% plus billion in revenue. Maybe they do 50 billion this next year, assuming they're growing at a teens rate. Management talked about, I think, high teens to low 20s. So I'm trying to be conservative. I'm assuming margins, though, much higher than where they currently are, 15 to 20% long term. This is giving them credit for, sort of the platform and, what they're able to, sort of squeeze out over time. I'm assuming a teens growth rate over time. And I'm also giving them a little bit higher multiple than I previously assumed, because I think their platform is more likely to survive, less likely to be squeezed. I think a bullish investor could actually assume even higher multiples, but I try to, keep a conservative perspective. So I'm saying around 20 times, earnings over the next, 5 years where I'm thinking about it. Keep in mind, it's already generating around $7 billion in free cash flow based on insurance add backs and stock-based compensation. So broadly, I'm looking at a stock that has the potential, keep in mind, this is a hypothetical. Of course, the stock price can go, way higher, way lower, a lot depending on, how do they execute and management sentiment and, could there be recession? So a lot depends on external factors as well as management execution. But, looking at this hypothetical framework, I think it's very, possible that you have over the next 5 years, 100% plus upside for Uber if they continue to execute. Plus you have, roughly 4 to 5% free cash flow that's going to you as a shareholder with either buybacks or accruing to you on the balance sheet with that cash building up. Or on the flip side, it's sort of a low case with only 10% growth, 15% margin, still much higher where they currently are. 20 times multiple 5 years from now, in which case it's closer to break even. Maybe you get, a couple percent, so a sort of mid single digit type of return over time. So I could see, I think about this framework and I could understand why Bill Ackman was buying recently, because it's very much that classical value investors mentality. Monish Pabrai talked about the Dondo investor, where it's this heads I win, tails I don't lose much. And that's what I think you're looking at with Uber from a fundamental long-term perspective of, hey, there's this potential for 100% plus upside, over time. And, maybe it's closer to break even or a little bit better over the next 5 years if they continue to execute. I hope this video walking through, what I think is Bill Ackman's thesis, as well as the latest developments that I think make it more favorable for Uber. I hope this video has been helpful for you. Thanks so much for watching Unrivaled Investing.